Hello dear students, once again I welcome you all to the 6th video lecturing session on financial markets and services. This subject is for the final year BBA students, that is 5th semester BBA students of Bangalore North University and Bangalore University as well. So moving further, the title of the class is Financial Markets. Subtitle of the session is Functions of the Secondary Market. Okay. So we have got quick recap on previous session. So in the previous session we had discussed about the meaning and structure of the secondary market. So just to brush it up, the meaning of the secondary market is simple. So secondary market is a part of capital market, and it is a platform wherein the financial securities that are purchased in primary market are sold and they are traded for the second time. So that platform we call it as secondary market. So initially, it is a part of capital market wherein the financial securities that are purchased in primary market are traded to the other persons or some other persons or investors. This we call it as secondary market. So it is clear. And when it comes to the structure of secondary market, we had figured it into 4 quadrants. So we had SEBI as a regulator, and we had investors and issuers, we had security exchange platforms, and we also had stock brokers as the structure forming pillars of the secondary market. So the learning objectives of the chapter, we have already read it out. We will just move forward. The session outcome, the student should be able to explain the functions of secondary market. By the end of this session, you should be able to understand and reproduce the answer, that is the functions that are discharged by secondary market. So we will move further. So here it goes like this, the list of the functions that are discharged by secondary market. The very first one is to maintain the liquidity and marketability of the securities or financial instruments. So now we have to analyze in what manner secondary market provides the liquidity and marketability to the financial instruments. Usually financial instruments are initially purchased through primary market, and those instruments cannot be retained by the primary purchasers or primary investors for a long time. Whenever they feel necessity of the money that they have invested, they want to get it back. So then that is where the secondary market plays a major role in providing the liquidity. So anyhow, financial instruments are not going to be repaid by the issuing company in a short term if they are the long-term instruments. So during such case, secondary market provides a platform for the marketability of the instruments that are purchased in the primary market. So that is how this first function is discharged by the secondary market. The secondary function that the secondary market performs is pricing of the securities. So now we have to analyze in what manner secondary market is going to fix the prices of the securities. So secondary market fixes the prices of the equity and debt instruments based on what? So based on the bids and the intents placed by the investors. So if a particular person is interested to purchase certain financial instruments, he quotes his prices for which he is ready to purchase, and at the same time the holder of the securities, that is the seller of the securities, he puts forward his price below which he doesn't sell his securities, and over and above which he is ready to sell his financial instruments. Based on the demand and supply principle, secondary market performs the fixing of the prices of the financial instruments. Now the third point is safety of transactions. So how does secondary market ensures the safety of the financial transactions? So it ensures like this: secondary market ensures the safety of the transactions by way of introducing electronic or digital interfaces and platforms of trading. So no buyers and no sellers need to meet physically or face to face at any particular point of time, and all the entire trading process is followed by the digital electronic transactions process. So in this manner, safety of the transaction is being established. And moreover, there is a mechanism for the settlement of the payments to ensure the safety of the both the parties, that is the investors and the sellers. There is a settlement, trading and settlement mechanism, so that will ensure the safety of the both the participants, that is the investors and the sellers. And the next function we have is supply of long-term funds. So how does secondary market supplies long-term funds? So it goes like this. Secondary market is a permanent market. So once the shares are issued and bought by the investors, usually money on such shares will be there with the company, even if the shareholders sell them to some other investors. Same thing happens even with long-term bearer bonds and debentures. In this manner, secondary market supplies the long-term funds. So in general, in simple, say suppose I have purchased 100 shares from a X company. So now I retain those 100 shares with me for 2 years. Now I want to sell the 100 shares. So who will repay me my money, whatever may be the prices of those shares after the 2 years? But now I want the value of those shares to be withdrawn, that is liquidated. Now company is not going to pay the value of those instruments because the terms and conditions of the issue would be usually equity shares are not repaid until the end of the company. If they are debentures or preference shares which can be repayable after 10 years like that, now I have the option I have is I can sell it to the third parties or the interested investors in the secondary market. So company is not going to repay the principal amount, but the third parties or the interested investors are going to compensate or going to pay the purchase consideration of those financial instruments, but the principal will be retaining in the company itself. So this is how the secondary market performs the function of supply of the long-term funds. And the next function we have is provides scope for healthy speculation. So what is speculation? How it is healthy speculation? We'll see. So securities are also traded for short term and even for very short term. So that is intraday transactions. Usually shares are purchased and sold after retaining them for 1 week, 6 months, or 1 year, 2 years. This is long-term investment purpose. But when shares are traded within a day, it is speculation purpose. It is done in order to gain the advantage of the increase of the prices of the shares within a day. So this is how it provides scope for the healthy speculation. So investors get the advantages of the increase of the share prices within a day. Okay. So next function we have is reflection of general state of economy. So secondary market reflects the general state of economy. How? So secondary market demonstrates general status of industry and economy as well, be it a company or industry, whichever is shining. So be it a company or industry which has got very good scope, its shares are traded at higher price and demanded more. In this background, secondary market also reflects the general status of economy and industry. And the next function we have is it helps in capital formation in the economy. So we'll see how it helps in formation of the capital in the economy. So every sector needs capital infusion for many reasons. Reasons could be expansion, diversification. Of course, companies can raise funds even in primary market and even they can capitalize in secondary market. That is different, angle. But every time investors do not stick on to a particular industry or a particular company, they get shifting their investments to different companies and different sectors. So that is how each industry gets capital formation in the secondary market. So these are the list of functions that are performed by secondary market. Of course, we have many functions that are performed by secondary market, but these are the list which we have listed out for the convenience sake. So we move further. We have it quiz. So let us move further. The first question we have is, does secondary market issue fresh securities? Options: yes, no. The right answer is no. Secondary market does not issue fresh securities. It acts as only a platform for trading of the securities. So next question: on which platform instruments are traded in secondary market? So secondary market acts as a platform. Again, in secondary market, what are the platforms what are the specific platforms that provides an opportunity for trading of the securities? So the options: central bank, listed trading agency, share issuing agency, and broker agency. So let us see the right answer. So it is listed trading agency. So in Indian context, we have two predominant listed trading agencies. They are BSE and NSE. BSE stands for Bombay Stock Exchange and NSE stands for National Stock Exchange. So the third question: does secondary market cater to long-term funds? Options: yes or no. It's a closed-ended question. The right answer is yes, of course. Secondary market caters to the long-term funds. So next question: liquidity of shares means what? So options we have got is being in cash, that is shares being in cash. No, it doesn't match. Shares cannot be in cash form. So having bank assurance, third option, that is option C, having central bank assurance. The fourth option, ability or opportunity of shares to get sold or in cash. So we'll look into the right answer. So it is ability or opportunity of shares to get sold or in cash. So option D is the right answer. So we are ended with the quiz. So this is the source of input or the content from which I have referred. You can also visit the sites which I have mentioned, and we can also refer the textbooks I have mentioned over the slide. Thank you. We'll meet in the next session.